Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Tuesday morning, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Morning.
Hi, good morning. Well, bulls continue to chug along. The news flow around trade deals is still keeping everybody sort of at the edge of their seats. So lots going for this market.
News on trade deals, but no trade deals as yet. So I think that's the way to put it.
It's coming. You can keep saying it. But actually, let's just hear it from the man, right? This is Treasury Secretary Scott Bessent yesterday, basically making that same point.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals. President Trump is going to be involved in all of those. He will be the final decision maker, and we'll see where that goes. I think we could see substantial progress in the coming weeks. We'll see. That I think it's Stein's law, that which is not sustainable doesn't continue. So 145%, 125% tariff levels are the equivalent of an embargo.
Yep.
And we're reading every day what's happening with factories in China. And from an academic point of view, I can tell you that the history of trade battles, we are the deficit country. The surplus country always has the most to lose.
Okay, lots of noise there. I mean, Treasury Secretary Bessent was sort of made a speech at the Milken Institute. It was a pitch about making in America. And of course, after that, CNBC sat down with him. And that's essentially a portion of the interview that we played out for you. In case, because of that noise you missed out, let me just quickly recap what he said. I mean, he said administration is very close to some deals on trade. Some deals could come as early as this week. And he went on to say that the China trade progress could come in coming weeks as well. Basically, they start talking at some point with regards to China, but some deals coming very soon, as early as this week. So, and of course, I mean, with regards to India, he said in the past, not this time, not last night, that India remains one of the first countries with which the US perhaps will get a deal going. Okay, now, the markets and what they did, we had a 9-day winning streak, and it was kind of getting unsustainable. So we broke that streak. S&P down about 0.6. NASDAQ was down about 0.7%. The 10-year yield about 4 basis points higher at about 4.35%. Dollar index 99.82. But I think this morning I saw the dollar index back at about close to around 100. The ISM services data was better than expectations, 51.6 compared to 50.3, which was the poll. I mean, you look at all these numbers, the GDP number, you look at the jobs data, you look at this ISM number, etc. And is this all kind of, in a way, quote unquote, brought forward data because of the tariffs? I think that's essentially what we have to see. The PMI numbers perhaps are more current and indicative of sentiment going forward. Oil prices about 1.7 lower. We are at about $60.28 as of yesterday, and we're at about 61 this morning. So this is important. Yesterday, crude sensitives, especially the oil marketing companies, sort of rallied hard. So that's a space to continue to watch. Now, just to tie in the levels here, the Nifty traded yesterday within Friday's range. I mean, if you just look at the high and low on Friday, because it was such a large move on Friday, we were within that. but we ended about 0.5% higher. The next level on the upside for the Nifty is 24,545, which is nothing but the 61.8% retracement of the entire fall. Yesterday, by the way, we took out the high of 24,457 by just about 3 or 4 points, but we ended above it. So the next logical level is 24,545, which, by the way, we got to on Friday, and then we completely fizzled out and ended flat. Major support 24,080 on the downside. Resistance for the Nifty Bank will be around the 56,000 mark. I mean, the levels have not changed. The Nifty Bank kind of underperformed the broader market. And of course, support here comes in at the 30th of April low, which is 54,723. GIFT Nifty will come up on your screen, gives you a quick sense of how we're likely to start. It's kind of flat, 10-point change this morning. Surabhi.
Absolutely. I mean, and flat is actually the word on Wall Street as well, because if you're looking at futures right now after yesterday's decline, a little directionless. It's going to be all about the Fed meet outcome. And it's supposed to be quiet. I mean, in the form of rates, we all know no rate change is expected, no rate cut. But the commentary, as usual, is going to be watched out. Asia this morning, first of all, a couple of markets are still closed for regional holidays. So we don't have cues coming in from Japan or South Korea. These are the ones that are open. And you can see a nice rally in some of the regional markets that are up and about. On the currency front, now, I mean, Monday was, a day of weakness for the dollar index. Now we're seeing a little bit of that recovery come in. And the yen has eased back to levels of about 144 to the USD. It touched 144. Now it's gone back to 143. So it's very range bound on the currency trade as well. Speaking of trade deals, there's a Bloomberg report that's talking about us, India. And according to that report, it's saying that India has proposed 0 tariffs on steel, auto components, and some pharma imports, but up to a certain volume threshold. So up to a certain threshold, it will be 0 tariff on a reciprocal basis. Above that threshold, there will be the usual tariff that will be imposed. So let's see, lots of trade talk and deal talk doing the rounds. The Nifty, despite all of this, I mean, the fact that banks were underperforming yesterday, it continued its winning streak, managed to put on that 0.5% because there's now participation coming in from other pockets of the market as well. Yesterday, consumer stocks, Reliance, all of them were firing. So the rally does have more legs. It's not a one-trick pony, so to speak, at least from what it appears right now. And flows have been very, very supportive. Yesterday, again, you had, buying from both the FIIs and the DIIs. The FII number was not as big as what we saw on Friday, but nonetheless 500 crores of positive numbers coming in from FPIs, and domestic institutions bought equity to the extent of about 2,800 odd crores. The flows, not a problem at all. Lots of individual stock action to focus on. First of all, we have a listing. Ather is going to be making it to the market today. Just reminding our viewers, the company raised, when we're talking about fresh issue, that's money coming into the company, that was about 2,600 crores. The price band was 304 to 321. If you go by a lot of the reports, the so-called grey market, it's supposed to be slightly quiet and muted, maybe 5-6 rupees at the pop. That's what the expectation is. Today is a very important day for Tata Motors as well, because finally the board is going to decide on the way forward for the demerger. So you get, one share of the CV business for one share of the existing business that you hold. So that's an important shareholders meeting that's coming up. Lots of results to keep us busy. And I'm just flashing up the list for you. And lots of very interesting large mid caps as well. So there's Godrej Consumer, BOB, HPCL, MGL, there's Aadhar Housing, CG Power, Kajaria Ceramics, Nerolac, I could go on and on, KEI, Radico Khetani, even Polycab, especially Polycab worth watching, considering the stellar show that we had from RR Cable yesterday. Last but not the least, watch out for Yes Bank. There are different reports, both in the Mint and the Economic Times, different papers reporting this, different wire agencies also reporting this, that Sumitomo, the Japanese banking giant, it is very close to getting RBI's blessings to take a large stake in the bank. Some say it could be as much as 51%. So let's see. Some reports suggesting there could be an open offer triggered. So Yes Bank definitely going to be on the radar as well. Nigel.
Well, the markets are clearly telling you that in the near term, we have a bit of a resistance zone. So that 24,550 to around 24,600, that appears to be a near-term stubborn resistance. Because for the last few trading sessions, it's close to around 8 sessions, we've consistently visited the highs of the day at around 24,350 to around 24,600. So that's the resistance zone that we're talking about. You'll see we're just 150 points away from that level. But the problem is this level is continuously getting rejected. I'll tell you what, if we can close above this level, then we are set for a fresh leg on the way up. Eye on the border though. I think that's the reason why, in fact, in the near term, we are seeing, some bit of consolidation and some kind of resistance at the highs. But the longer we go through this consolidation phase, the sense you get is the breakout could be even bigger once all of this dust cleared out. So let's see how that goes. What about the FIs? What are they doing? They're pumping in some money in the cash market, and in the futures market, they've been covering their shorts and they're gradually moving to the net long position. And even in yesterday's trading session, they added some longs. They're still net short, 51.5% positions on the short side. But now they're moving to that even-Stevens part. So that's why if you look at the FI net shorts, that's come down to just 5,000 contracts, while the clients, they're net short by close to around 27,000 contracts or thereabouts. But what are they doing in index options? It appears that in case the market is going to break away, there is some out-of-the-money call buying that we're seeing. Even in yesterday's trading session, they bought more calls than puts, though they're writing pretty much, one put for one call. At least that's what we saw in yesterday's trade, which brings us to the options data. The 24,500 call, well, it added close to 50 lakh shares, and the 24,000 put as well. And these are the most active strikes, and this is the broad range that we're looking at. So let's get the levels up for you on the screen. In terms of a downside, just for the day, you don't want the recent, the recent low. That's the low we saw last week, around 24,200. That's your reference point on the downside. While because this 24,600 mark has been getting resisted, we're likely to see that this is the broad range for the day itself. The Nifty Bank, yesterday as well, we saw some unwinding of positions. You had a couple of result, disappointments out there. And that's why there was some unwinding of positions, which is causing the Nifty Bank to see some kind of selling from the top. But I think the Nifty Bank is in this broad range. The recent high as well as the recent low in that vicinity of around 54,000 on the downside and around 56,000 on the upside. That seems to be the level. In the last, 10 sessions or so, we have gone there more than thrice, and that 56,000 mark has got rejected. So we'll see how the Nifty Bank goes. Those RSIs that had popped up to a very, very high number, to around 76 odd, that's cooled off a little bit. So let's see whether or not the Nifty Bank is ready to take up the mantle again.
All right. And I think China is back in terms of
trading action. Yeah.
And where it is showing up in a meaningful way is gold prices. Gold prices are
2.5% higher.
About $100 since day before yesterday.
Just one more point. This Trump uncertainty is just, causing a lot of companies to go ahead and pull away their guidance. Ford overnight, they pulled away their guidance. Mattel as well, they have pulled away their guidance. I think 20% off their total goods. Yeah. So the, Barbie prices are set to go up, I guess. So.
Yeah.
He said, right? You remember a couple of days back, he said, why do, young, wonderful girls need so many dolls? Why do you need 100 dolls or 100 toys? You should have, few. That's what he said to American young girls.
Just connect to my doctor.
All right, let's welcome in Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, good to have you with us here. Good morning. Thank you for joining us. I mean, I think what the Treasury Secretary said, that I don't know if you heard that soundbite we played out. This was in an interview with CNBC last night. He said, well, I have, the information flow is asymmetric. I have information, so I'm very confident. You don't have it. Markets don't have it. So you're kind of nervous. And he said, well, some deals could come as early as this week. But even as that may be the case, Matt, do you think markets generally have run up and kind of have repriced completely? I mean, recouped all losses since the April 2nd Liberation Tariff Day. So now you're going to run into some hard data. Even as news flow gets better on tariffs, headlines get better, markets have recovered. What's your sense?
Hey, good morning, Prashant. It's always great to join. And that's really the key question I think a lot of investors are trying to digest is, to what extent will we see the hard data start to roll over? I don't think anyone would argue. I certainly wasn't arguing coming into this year, not knowing anything about what tariffs were going to look like, that economic data was going to slow because it had been so high for such a long time, and we knew we were going to be pulling back some fiscal spending in the U.S. Tariffs obviously accelerate that. What I think is critical, though, and what Bessent has been alluding to, is that the administration has been listening to the markets. The administration has seen the market reaction to, I'd say, some of the worst inclinations or the negotiating tactics, per se, of tariff policy. And you're seeing those left tail scenarios be removed. We're finally talking about trade deals. I'd love to see some of those trade deals get signed. I think perhaps India, Japan, South Korea are probably going to be amongst the first ones that we see. But that at least, I think, gives a signal that the tariff policies as it stands and as we're likely going to get to, in and of itself, isn't enough to drive the economy into recession. I think that's reflected in the strength of the hard data that we're seeing. And from the market perspective, a lot of companies that are tied to the technology sector, a key part of the overall market, remain in really, really good shape. We've seen great earnings, and they haven't pulled their guidance. They've actually maintained or increased their guidance going forward.
Matt, hi. Great to have you on. So, in the midst of all this uncertainty, what's the sense? Broadly, do you see the U.S. market heading higher? I mean, it now believes that some shape and form of these deals will start coming through. So, from a market standpoint, is the direction still up for the U.S. and then markets like India?
Yeah, it's a good question, Surbi, and I think you want to look at it two phases. Number one is what's going to happen in the short term. And in the short term, I'm a little bit cautious. Short term meaning the next couple of weeks to a month. And that's largely because a lot of good news has already been priced in. We get the FOMC on Wednesday, as you mentioned earlier in the program. And I think that can be a catalyst to maybe have the markets pause for a little bit and say the Fed is not here to come to the rescue should we see hard data start to roll over. So I think the bond market has some repricing to do. I think the rate cut expectations are too high. And I think that could lead to maybe some sideways movement, some consolidation. And that is a good opportunity for long-term investors to start to use opportunistically. Because as you know from our conversations over the past few months, I'm very glass half full with respect to where the economy and the market can go over the next year plus. I think earnings will continue to be strong, but the key message that I give to clients when using downside opportunistically is that this isn't a market that you want to buy as the market. You want to lean into specific stocks, specific sectors where there's durability with respect to earnings growth. And I think that applies to markets like India too. A lot of good news has been baked into the Indian market. I've been encouraging clients to use India as a ballast in portfolios, but a lot of the high quality names that have been my favorite picks over the past year that I've really leaned into in weakness, these high quality names have reported great earnings. And I think the outlook looks very, very bright. So I'm still encouraged by India. I don't want to chase the upside. I want to let the market come to me so I can continue to slowly and opportunistically add.
All right. Hi, Matt. Always good to hear your thoughts. Well, as you have mentioned in the past, India is your preferred market, but stocks is something that you like. So give us, first I want you to comment on the European markets. Last night I was just pulling out some data with regard to how equity markets are, how far away are they from all-time highs. And the DAX was 0.5% away from those levels. So the European markets clearly have bounced back. What's your view on the European markets? And since you spoke in India, you like high-quality names. Name a few for us.
Absolutely, Nigel. So Europe is really interesting. I came into this year optimistic on Europe, particularly banks and defense companies. And I think the story for Europe is one that's still characterized by central bank easing. So financial conditions are going to get easier across continental Europe. You have growth that has likely bottomed. We're probably going to see trade deals come, but what's most important to, I think, the European story is the fiscal impulse you're getting from countries like Germany that have committed 500 billion plus euros to rearming the continent. So I think the defense play has a lot of legs to go, even if you do get ceasefires. So I think there's a lot of good investment opportunities across continental Europe. Again, I might want to lean into financials, defense, perhaps some consumer-oriented companies more in the luxury goods space, and avoid some more of the names that are still tied up to China, because that's an area that I think is going to suffer from dislocations, at least in the short to medium term. You flip to countries like India, some of my favorite names, my biggest overweight by far right now is still ICICI Bank. That's been a name we've talked about a lot. I think it's the highest quality private bank in the country. You've seen really, really strong earnings. You've seen net interest margin strong, loan growth improving. There's not much not to like about the stock going forward. So again, I would use any sort of dips opportunistically. And other names that I had been accumulating kind of later in the year on some of market weakness, like HDFC Bank, they've also reported very strong earnings, net interest growth, and they're finally starting to see loan book growth, which is a really encouraging sign about the Indian economy and the state of their business as well. And another name that I lightened up maybe a little bit too much that I think I might look to add to that reported earnings yesterday was M&M. Mahindra & Mahindra reported really strong earnings. I liked the growth, the surprisingly strong growth in the tractor segment. You're seeing them in a really strong SUV market cycle. So again, that plus some of the mergers that they're starting to do, that looks like it could be a continued growth story to me.
All right.
Yeah, absolutely. In fact, Matt, we spoke with the management, the M&M management. They were here in the studio yesterday. And indeed, I mean, that's what we were quizzing, that they seem to have found that sweet spot between volumes, pricing, and how do you get that margin up and about as well. So, yeah, M&M was quite the stock yesterday.
Absolutely. And Matt, it's always great speaking not just macros, but stock-specific stuff with you as well. Thank you very much for joining us, Matt.
Thanks.
Great conversation, as always. We'll take a quick commercial break here. And before we do that, as always, let me just quickly run you through what's lined up here in terms of interactions. So at 8:35, J&K Bank will join us on the earnings. 9 o'clock, we have the analyst at JM Financial Institutional Securities talking about the recent fall in oil prices and, of course, increases in CNG prices in Delhi. Vikash Kumar Jain, CLSA, is the market master of the day at 9:50. 9:30, the management of Coforge. That's the big beat that's come through last night. The management comes in. So, we'll have Sudhir Singh talking to us about that. Anuj Kumar of CAMS will be with us at 9:40 to talk about their earnings. Ajay Kumar Srivastava of Indian Overseas Bank at 9:50. And towards the end of the program, it's a special segment. It's the economy. Latha in conversation with Pranjal Bhandari of HSBC on India growth later this year.
Well, time to slip into a short break, but we got a lot of stock-specific action we're going to be focusing on. We get that on the other side of the break. For the time being, I'll give you a sneak peek. Indian Hotels, Coforge, OneSource Specialty Pharma, DCM Shriram, Glenmark Pharma, IEX and Yes Bank, all of them will be reacting to positive news flow, while we have CAMS, Cummins, as well as pharma stocks that will be reacting to negative news flow. Slip into that break and come back. We'll get into further detail.
Welcome back. So Qs are not too bad across Asia. Some of the markets are shut, but the ones that are open, for instance, Hong Kong is back. I mean, it's pointing to a recent 0.5% kind of a move. Lots of stocks in focus as well, and we will get down to that in just a bit. The implied open, let's look at that as well. It'll come up on the screen because while Wall Street futures are flat, Asia is not bad. And therefore, we're getting a slightly positive start, at least for now. Okay, let's get to stocks then. And we have our team standing by with the CNBC-TV18 list of top stocks for the day. Guys, morning to all of you. Indian Hotels came out with numbers, Mangalam, with everybody checking in and taking these dream vacations. I'm guessing they were looking good.
Well, there is no surprises there. It's a great set of numbers that has come in, and it's a good performance that continues. The stock has been quite a wealth creator and currently very close to its record high as well. And the consolidated numbers are further aided by Taj Sats consolidation. Remember, they had added Taj Sats, the air catering business, in July itself. So 27% revenue growth, 30% EBITDA growth, margins crossing that 35% mark, and net profit growing at around 28.5% as well. Hotels, year on year, there was a mild decline in the revenues and EBIT, but that was largely done away with strong occupancy as well as ARR. So occupancy grew to 80.1% and average room rate grew by 14.4%. Remember, from 18,368, it's jumped all the way up to 21,013 itself. The company maintains its outlook for FY26, 30 new hotels, focus on total RevPAR growth, continued momentum of new businesses, and they're also adding a new kitchen at Jewar Airport for Taj Sats. All these factors should do well for the stock, expected to be in the green today.
All right, Mangalam, thanks a lot for that. Well, let's hop across to Rima. She's tracking Coforge, and the numbers look quite good. Rima, tell us more.
Indeed, it's a good quarter, particularly delivering on the growth front. Yet again, the company's top line has gone up by 3.4% quarter on quarter, slightly ahead of the CNBC-TV18 poll of 3.1%. They've wrapped up FY25 with a 32% top line growth. But remember, that includes the Cigniti acquisition. Deal wins are strong, which means it positions the company well for the upcoming year. In Q4, highest ever deal wins at $2.1 billion. But that includes that large $1.6 billion Sabre deal. But even if you strip that out, you would still be at a run rate of $500 million. The company's 12-month executable order book has gone up by 48% on a year-on-year basis. The management held a conference call yesterday where they reiterated, they said they're confident about achieving the $2 billion revenue aspiration by FY27 and also on expanding margins. Remember, the stock is corrected. It's down 22% on a year-to-date basis. MK today upgrades the stock, citing the recent underperformance and the correction in the stock price. Jefferies maintains a buy, and their revised target stands at 9,000 rupees per share.
Absolutely. And that's essentially the big outperformer. And Sudhir Singh, and we've discussed this over the last many weeks. how confident the Coforge management has been in the past. And, of course, the guidance coming through equally strong. It's also, of course, come off the lows, right? 6,000 to 7,500 in short order. So market was kind of well prepared for these strong numbers. So we'll see what the stock does. It'll be an interesting day. You'll hear from the management at 9:30. One source specialty pharma in focus now. Ekta is here with details. Ekta, morning.
Morning. Well, I'll look at the Q1Q numbers because that'll give you a more realistic picture of the company. Revenue was around 426 crores, so it was up around 9% Margins have improved quite significantly, so all the way to around 42.8% this quarter versus 36.15%, and a profit of around 98.5 crores. Now, in terms of the FY guidance, FY25 guidance, they've met it because they had guided between $160 to $180 million and EBITDA of $55 to $61 million. So they've met that guidance there. And in terms of what they are projecting in the next couple of years, revenue growth guidance of over 30% between FY25 to FY28 and steady state EBITDA margins of 40%. FY26 is expected to be a pivotal year for OneSource. Probably expect the stock to be in the green today on the back of numbers.
Got it, Ekta. Thanks a lot for that. Let's hop across to Ria. She's here to tell us about DCM Shriram. Ria?
Well, DCM Shriram has reported quite a good set of numbers in this quarter. The revenue has gone up by around 20% on a year-on-year basis. Both the net profit and the EBITDA have also seen increases of around 15% over the previous year. Even on the margin side, we've seen an expansion coming in at 14.1% versus 11.1% that we saw in Q4 of last year. Taking a look at the chemical segment specifically, caustic soda volumes were up around 29% on a year-on-year basis on account of the capex that the company has undertaken. Overall, lower input prices and operational efficiencies have led to improved cost structure for this segment. For the sugar and ethanol business, the domestic sugar volumes and prices have increased by around 19% and 5% respectively, both on a year-on-year basis. Overall, we've also seen better margins in this segment on account of higher sugar prices. The management has also commented on the results, saying that demand for caustic soda has improved, but chlorine has remained under pressure, and hence ECU prices are still suboptimal. They've also said on the sugar and the ethanol business that has remained largely stable, and sugar stocks for the sugar season 2025 are expected to be lower, which will support sugar prices going ahead. So overall, good set coming in for DCM Shriram, and we're expecting the stock to open in the green today.
Okay, Ria, thank you very much for that. Well, on to Ekta, who's with us in the studios today. Ekta, Glenmark Pharma on your radar. Morning.
Morning. Well, yes, one of their molecules under development, ISB 2001, has received US FDA fast track status. Remember that this is a molecule which is being studied for relapsed multiple myeloma type of cancer, that if in case, 3 treatments don't work on it, then this is the kind of drug that you go to. The drug is, the fast track that they've received from the US FDA enables expedited drug approval. And remember that they've already been granted orphan drug status in 2023. It's currently in phase 1, and the complete results are going to be shared on June 2nd, 2025 at the American Society of Clinical Oncology. HSBC had written some time ago on this, and they've written a note today as well. Don't have that note as of now, but HSBC is basically very bullish on the fact that this molecule could be an out-licensing opportunity and a re-rating trigger for Glenmark.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go across to Vamakshi. Cummins, that's the stock in focus. The global parent went ahead and withdrew its guidance, and the commentary on India was weak as well. So we're bracing for a weakest set in Q4. Vamakshi, tell us more.
Well, absolutely, Nigel. Very good morning. Cummins definitely in focus after its parents reported its numbers for the first quarter. Now, the first factor that came out is that they've withdrawn the guidance. They've withdrawn the full year forecast, and they say this is on account of tariff-related uncertainties. Now, keep in mind, earlier they had shared a guidance wherein the parent was expecting a revenue degrowth of -2% to a growth of almost 3%. The power gen revenues for the global parent were expected to expand by anywhere between 5 to 15%, while for the India region as a whole, they were expecting a growth of nearly 10%. But now they've gone ahead and withdrawn this guidance given the tariff-related uncertainties. The second important point that came through from the earnings con call is that the revenue for all Cummins entities in India, which includes Cummins India, some other entities as well as JVs. In the first quarter, the revenue saw a downtick of almost 14%. The third point is the power gen business in India for the quarter ended March saw a revenue downtick of almost 11%. The revenue has declined as compared to the previous year, and this is mainly on account of the pre-buy that came through on account of the emission norm change in the same quarter last year. So therefore, given the kind of commentary that came through from the company, especially on the power gen business, which constitutes nearly 40% of Cummins India's revenue, negative read-through for Cummins, expect the stock to open lower today.
Okay, all right, Vamakshi, got that. Thank you very much. Cummins on our radar as well. Let's move on, talk about IEX. It came out with its business update. Vivek, morning, how does it look?
Well, good morning. That's right. So IEX is in focus. It's on back of the fact that the company has given the operational update for the month of April. So the traded electricity volumes, as far as the DAM market are concerned, up almost 26% on a year-on-year basis, 10,584 million units. The day-ahead market volumes up 3%. And when you're talking about the electricity market volumes, it's up almost 48%. Market clearing price, despite much higher volumes, remains quite steady at 5.2 per unit. The company attributes this to higher sell-side liquidity as far as volumes are concerned. Now, when you're talking about the renewable energy circuit, it's dipped on a year-on-year basis, but this is off a lower base and it's been quite volatile. That has been the trend as far as the REC market is concerned. A total of 2.9 lakh REC certificates were traded in April. It's a good it's a good print as far as the operational update for the first month of FY26 is concerned. Expect some green on IEX today.
All right, Vivek, thank you very much for that. Let's talk about the other company, which we're going to speak to a little later. CAMS in focus. Vamakshi is here with details. Vamakshi, morning.
Good morning, Prashant. Not such a great set coming in from CAMS. When we look at the revenue, the operational profitability, as well as the net profit, it's a mild miss as far as the consensus estimates are concerned. The revenue is seeing a degrowth of almost 4% sequentially. The operating expenses, on the other hand, are rather flat. Therefore, the EBITDA margin has come under significant pressure, down nearly 200 basis points, coming in at 44.75%. The net profit has also seen a sharp fall of almost 8% sequentially. Let's also look at how the different segments performed this time around. The major degrowth drivers for the company is the MF assets-based business, which saw a downtick of almost 5.4%. The MF non-assets-based business also saw a downtick of almost 4.4%. Think 360 AI and CAMS KRA2 reported a degrowth in their revenues. But on the flip side, good performance and in fact very strong performance came in from CAMS Pay, up nearly 44.5%. CAMS Rep 2 saw an uptick of almost 26%. So mixed performance as far as different segments of CAMS are concerned. Let's also look at the company's operational performance then. Overall AUM saw a downtick of 1.5%. The equity AUM too fell higher by almost 3.1%. But keep in mind that the decline in the overall AUM as well as the equity AUM is much lower as compared to the decline that has been seen in the wider industry. So this is slightly positive. CAMS has also managed to gain its market share in AUM as well as the equity AUM. So therefore, it's a marginal miss, going with a mild red for this counter.
Okay, all right. Thanks, Vamakshi, for that. And in fact, we'll be speaking with the management, Mr. Anuj Kumar. The management personnel at CAMS is going to be joining at 9:40 a.m. We'll talk more about these trends. Back to Ekta, then she's watching out for a couple of other pharma stocks as well. Which ones are these, Ekta, and what's the news?
Well, I will be watching out for the pharma index because I expect a sentiment negative to at least weigh down. This is after the US president signed an executive order to boost US drug manufacturing. Now, it's important to understand that they are not disincentivizing imports at this point in time. What they're trying to do is reduce the approval timeline for pharmaceutical plants to be set up in the US, because there were some indications that it can take as much as 5 years. So according to him, 5 years is too much, and hence we need to expedite that process. Remember that the likes of Roche, Novartis, Eli Lilly, J&J, they've already indicated that they're investing in the US in terms of manufacturing. Now, what else do articles indicate today is that the FDA could enforce stricter reporting by foreign API producers. Non-compliant overseas plants may be publicly listed. could see surprise foreign inspections. Now, remember that a lot of the pharmaceutical companies are already used to complying by all of this, but this could be an additional sort of scrutiny which could weigh down negatively on sentiment-wise. Now, the bigger picture and the larger picture is that the industry is facing uncertainty over tariff rates and timing. So the US, remember, imports over $200 billion in terms of prescription drugs. He's indicated that the government has indicated that we could hear in terms of imports of probably in the next 2 weeks, import tariffs in the next 2 weeks when it comes to pharmaceuticals, and hence that is the larger picture which could weigh down.
All right, Ekta, thanks very much for that as well. Yes Bank is the next one that we want to highlight. Abhishek has got details on what he's picking up. Abhishek, morning.
Morning, Prashant. So as per LiveMint, Sumitomo gets RBI's nod to pick up 51% stake in Yes Bank. Now, this may value the lender at around $1.7 billion. Now, SMBC will either buy less than 26% or, they may do a merger through share swap. They may also buy up to 26% and then give out an open offer. SMBC's voting right in Yes Bank will be capped at 26%, and SMBC will buy up to 51% stake in Yes Bank at market price if need be. Now, CNBC-TV18 has not verified this news report independently. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. We'll keep an eye out on that one. Well, let's do a quick recap of all the top stocks we covered for you. We have Indian Hotels, Coforge, OneSource Specialty Pharma, DCM Shriram. We have Glenmark Pharma, IEX, as well as Yes Bank. All of them will be reacting to positive news flow. On the flip side, 3 of them will be reacting to negative news flow. CAMS, Cummins India, and Pharma stocks. Let's take that mandatory break, come back, and we'll have the management of J&K Bank. They'll be waiting to discuss the past quarter's numbers and how do they see things pan out going ahead. Later on, Prakash Diwan as well will be joining in for some funda market check. Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to the management of J&K Bank. We're currently joined by the MD and CEO, Mr. Amitabh Chatterjee. Hi, Mr. Chatterjee. Good morning and good to see you. Well, before we start off with this conversation, focusing on your numbers, post the Pahalgam terror attacks, wanted to just lend all the strength, all the support to you, your personnel, all the staff at J&K Bank as well. The nation's with you all in this time of trouble, and we're going to pull through and we're going to conquer. Before we get to the numbers. But let's talk about business first. For J&K Bank, give us a few basic details. How much of your business comes out, outside Jammu and Kashmir? If you could give us a breakdown as of now, and how do you see things panning out from here on?
Okay, thank you. Thank you very much. Good morning. I hope I'm audible.
Absolutely.
Regarding your question, well, it's about 67 and 33. 67% of the business is in Jammu and Kashmir and 33% in the rest of India. Okay. So it is slightly shifting now, maybe because of obvious reasons of diversification. So that is how it is at the moment.
Well, there must be a very, very challenging phase for you, sir. As of now, the way you look at it, how do you see growth going ahead for the business? And I guess the focus will be on the non-J&K book, given the the current trouble that we're seeing.
Yes, if you are mentioning about the Pahalgam attack, yes, there would be some effect of that on the tourism, and all of us here we are looking forward to the Amarnath Yatra coming out successfully, so that we can have the tourists back. Apart from tourism, I think much of the remaining business will be as usual. The main contributor to the GDP of this UT is, of course, agriculture. So if you want to ask me about the impact of tourism to the banking industry here, it would not be much, because we have done an assessment the total exposure to the tourism, including the hotels and the transport, would be around 1% of our total portfolio. So direct impact will be not much. And in the past also. Sorry, yeah, please.
Right, sorry. Mr. Chatterjee, good morning. So, but direct and indirect, sir? Dependence on tourism?
That's what I was saying. Dependence on tourism for the bank directly is only 1%. And in the past, when this is not the first time this geography has witnessed such incidents. So in the past, the maximum stress that had happened because of such incidents was 14% of stress, which actually during the next 2 to 3 years came down to 2 to 3% only. So the resilience is very strong, and the propensity to repay and to maintain good, credit. The people of Jammu and Kashmir have a high propensity to repay and not to default. So that way, I don't see any direct impact. Indirectly, yes, of course, tourism also contributes 10% to the GDP here. So there will be impact on the other sectors, and that we will have to wait and see how much it impacts the bank.
Mr. Chatterjee,
yes.
Sorry, you said in past instances, it's been the impact has been about 14%. What was that number? 14% of?
14% of the total portfolio. I mean, I said the total portfolio is 1% of our business portfolio. I mean, that is the total advances, the loan. So it was about 2,500 crores would be the total exposure, and the impact on of tourism would be around 1,000 crores only.
Okay, so you're saying that so if we understood that correctly, sir, tourism and allied sectors constitute right now 14% of your book. Is that right?
No. That is
1% of your book.
1%
okay, 1% of your book. Okay. So what was the 14% number, sir?
That 14% I meant was the NPAs went up in that particular sector to up to 14%. So that is around 140-50 crores, that's all.
Got it. So within the tourism part of your book, which is just 1%, which is of course very small, the impact was 14%. Got that. So let's talk about growth, because in the quarter gone by, the bank has shown very robust growth. I mean, whether I look at it year on year, 11%, even quarter on quarter, 8.5%. Is this growth coming in from the J&K part of the book or the non-J&K part of the book? And since right now you're saying that the impact should be limited, what should we expect over the next 1 or 2 quarters in terms of AUM growth?
See, the normal growth that will happen in this geography would continue to happen because a lot of dependence is on agriculture. So agriculture, this is the season, and we have seen post-March also substantial credit takeoff in the agriculture sector in our bank itself. So I do not see any reason why that will not grow. And to get back to your question, the growth that came in the last quarter of previous financial year, it primarily came from the corporate banking from rest of India. So that always will remain as a second line of defense for this bank. Essentially, as I told you, almost close to 70% of the business happens in this chain.
Fair point, sir. Sir, got your point. Just can you give us some sense of a number so we know for FY26, since you're saying right now the Pahalgam impact is fairly contained. For FY26, should we expect your book to grow at what, 11, 12%, 10%, some range?
Yes. 12% would be a fair assessment, and of course, it might be more depending on how it pans out.
And NIMs would be closer to that vicinity of around 3.8 to 4%?
I don't think so. If you look at the repo rates going down, the NIMs will be under a little bit of pressure. I expect it. I would be happy anything around 3.7.
3.7%. All right, Mr. Chatterjee, thanks a lot for joining in. Appreciate you giving us some guidance. Things still a little bit uncertain out there, but we look forward to chatting up with you. And please stay safe and sending all the strength to you as well as your team.
Thank you very much. Thank you.
Well, let's get in Prakash Diwan then, our market expert. He's here to help us out with some fundamental analysis. Hi, Prakash. Good morning and good to see you, Ben. Well, what's your pick from the banking pack? You heard what J&K Bank, had to tell us about their business. Things are uncertain over there. But a couple of large funds as well, they had put in some money out there and they were quite optimistic about a turnaround. Unfortunately, with these uncertain events, we'll have to see how things pan out. You have Yes Bank, where there's a potential deal. Sumitomo is looking at picking up a stake. That's what unconfirmed reports indicate. And yesterday, you had a couple of these banking names, like a Kotak Mahindra Bank, that did see some selling. So what do you like from the banking pack?
Good morning, Nigel. So let me also just add on the J&K Bank. It was a lovely discussion that you managed to have with the management. The numbers of the last quarter, wherever you see the improvement, actually tell you how much on track this growth was, before this attack happened and derailed, or at least has created a pause of sorts or question marks around it. But actually, if you see, the local economy out there is shaped up so brilliantly. It's just that the people have to realize what's beneficial for them and continue supporting that. But the numbers very clearly tell a very different picture, and there's enough to read between the lines. On the banking side, the way I look at, I told you, it's the private sector, largest banks which will take off first, which they did with the ICICI, HDFC, and Axis of the world. Kotak also did its bit, of course. But it's now, the smaller banks or the mid-sized banks that will start contributing because, they are the ones who are much more agile. And as the credit offtake period starts kind of picking up, you'll probably see that. So if you recall, we mentioned about DCB sometime back when the numbers came. I seriously think that's like a bank which is underrated in terms of what it is capable of doing. It has very strong CASA franchise, lends to the right segments, doesn't do very stuff which is very adventurous except for, the yesteryear's plan to grow branches, which they stopped. So, when you look at something like that, you believe that if the cycle needs to kind of take off and ROA start kind of moving strongly, these are banks that you need to look at where the delta is higher. Otherwise, you'll probably have, even Federal is good, but Federal is, saturated at some point. They'll have to reinvent themselves. And that's why, the numbers weren't very encouraging or the market reaction wasn't equally encouraging. So that's a point. But I would look at a smallish bank for sure at this point in time. Otherwise, the biggies like ICICI and all definitely continue to hold promise, but that's more of an institutional play. Retail investors could probably look at something smaller. They don't need very high liquidity on a daily basis.
Prakash, morning. Would Yes Bank be one of the smaller banks you look at? It's in deal zone now. We don't know pricing. We don't know whether open. I mean, there are different reports. One suggests there will be an open offer. Others suggest it could be some different sort of a different structure which doesn't involve an open offer. So we don't know a lot. What are your thoughts?
No, good morning. So absolutely, the bride is ready, but whether the marriage will happen and who's the group, what's very peculiar about this is that there are lots of things that need to kind of get stitched up before a deal actually happens in terms of, permissions from other lenders and other creditors and so many of the investors themselves. There's a lot of equity at play with the biggies like SBI and all, also a very clear stake there. My sense is every rise in Yes Bank will probably be seen as an opportunity for a lot of the investors of the past to exit. It's been quite some time, almost 4 or 5 years that it's been languishing in this zone. So a lot of people will find exits rather than, look at buying into the dip. So you'll see selling pressure because the equity is bloated. And till all of that gets to stabilize at some point, the equilibrium arrives, I don't think it's a great delta. It's a special situation thing. Let's wait for what comes through. Then it'll probably be easier to assign some timelines to it. But right now, I think it's just a lot of hope that's building on it.
I was just looking at it. The peak for Yes Bank was February, 9th February to be precise. That's when the stock touched 31. I'm forgetting who was the suitor or the buzz back then. But it was, again, similar sort of buzz that got the stock to that level. But that was 31. Today, we're talking 17. So let's see. That's Yes Bank. Prakash, Coforge, another good quarter. Your thoughts? And what would you do with the stock?
So, this is a very consistent player, keeps delivering in its segment. But, how long will this brilliant runway last, given the situation in the US and particularly rest of the world? I mean, I would believe, some of these stocks are priced to perfection at some point. It'll be difficult for them to be able to keep delivering as per expectation. So it's good to temper down your expectation. I'm sure, once we hear the management, you'll get to understand a lot of things that are going their way and some which are not. So once that's understood, it's probably easier. But I'm staying away from IT generally by and large at the moment because, things could reverse very badly if something goes wrong on tariffs or the countries that come with these bilateral agreements are not very significant or relevant or impactful. You'll probably have a little bit of dilution on that. So I would stay away from IT. Of course, no taking away the fact that the numbers have been brilliant. Company continues to deliver, but it's priced to perfection.
Okay, all right. Prakash, request you to stay with us for the time being. We take a short break. You come back. We'll have Prakash still with us, and Mitesh and Sudarshan will be joining in to give us their technical calls. Don't go anywhere.
Okay, welcome back. We've got, 7 minutes to go for the pre-open session, which will kick off. I mean, nothing on it, actually. 10 points, 11 points is all we have. Sudarshan and Mitesh are with us with what they'd want you to do in terms of specific trades. Gentlemen, good morning. Great to have both of you here. Mitesh, you go first. 0.5% gain yesterday. And is there more coming, or it's going to be a little more cautious, measured from here? What's the sense?
Good morning. So, yesterday I was believing that we could possibly see some more upsides immediately. The way the price structure shaped up, and I was hoping that the indicators would again start climbing. That has not happened. So I think we might be in for consolidation. 24,520 is an area which I would want closing above that. I think once we get that, then there will be much more comfort to take long positions. Otherwise, I would wait on declines to buy. Though on individual stocks, we do have long biases.
Okay, all right. Got that. Thanks for that, Mitesh. Sudarshan, what about you? How are you feeling about the markets?
Good morning. Well, not feeling very well. I mean about the markets. See, yesterday was a narrow range day. Now, narrow range days usually lead to an eventual breakout or breakdown. Given the fact that we are in a slightly confusing atmosphere, it's difficult to say whether we are going to go down or go up. So my view is that do nothing in the Nifty unless we see a decisive move out of a narrow trading range. So either we trade above 24,600, which is far away from the opening price, or below 24,300. So there is a 300-point zone where no trading should be done. If we have a decisive breakdown, we'll go much lower. If we break out above 24,600, we'll go much higher. The chances are this may not happen today. That's fine. If that doesn't happen, don't trade.
No, fair enough, and hope you feel better soon, Sudarshan. What would your trades be?
Oh, no, I was feeling fine. I said
He's
the markets
feeling fine.
are not very good.
I thought markets are fine and you're not feeling fine. I got this backwards. But go on.
Well, it's an all-long strategy today, and simply because even as the markets are sideways, there are stocks that are doing interesting things. Adani Enterprises is a buy. We had a big up move. So wait for a minor dip and then go long with a stop under 24.15. Jubilant Foods is a buying opportunity, stop under 706. Another FMCG ITC is a buy, the stop under 412. And finally, Hind Petro is a buying opportunity with a stop under 402. This is probably a better idea. Focus on mid caps and let the index be.
Yeah, I mean, the Adani stocks all surged 9, 10, 12% across the board. HP, of course, was the other big outperformer yesterday, shown through 7% or so by close. Mitesh, what would your trades be?
I have more of buy calls. I think RT Industries had a good price action yesterday. So buy here with the stop at 442 for targets of 470. CESC is a buy with a stop at 162 for targets of 171. And Inox Wind is a buy as well. Keep a stop just around 169 for targets of 180. One sell call, there's Federal Bank. Keep a stop at about 195 half. Look for targets of 182.
All right, Mitesh and Sudarshan, thank you very much, both of you, for joining us with that perspective. We'll take a quick commercial break here. We're going to come back with a pre-open session. That's in about 3 minutes' time. Dayanand Mittal, JM Financial Institutional Securities, also with us. on, of course, the big fall in oil prices. It's a big disinflationary boon for global markets, global economy, but we'll drill it down to individual stocks that Dayanand likes at the back of this. Stay with us.
Welcome back. Just about 15 minutes to go before the market opens. We'll start getting our pre-open rates very shortly as well. Prashant, let's talk about wire and cables. Yesterday, RR Cable was the star. Today is Polycab's turn. So let's see if the numbers will be as good or not. Never a dull moment here. Do you like anything in this space? KEI, Polycab, RR Cable, any of them?
If you own them, it's worth holding on for the simple reason that the upcycle continues to favor most of these plays. But what's going to be interesting, what's going to be very interesting is the derivatives that go into manufacturing of all of these, so specialty polymers, whatever companies are there in that. So one of them happens to be from the Supreme group of companies. They supply a lot of these raw materials. So I think the space is expanding. The unorganized to organized shift is right there. It's going at full momentum. And the other thing is that all the lapses that you saw, leakages that you saw in terms of cash sales and all, it's completely out of the way. So there's a very different pace that they've set up, the organized pace. Competitive intensity has taken its toll, brought valuations down, but they're still richly valued given the growth expectations. So if I had to pick any of them, I would wait for weaker times in the market. But yeah, I would believe all of them, and we'll of course get to see what Polycab's the numbers tell you as far as the industry trend is concerned. But it seems quite promising.
Okay, all right, Prakash. I think the casualty of the morning could be Cummins. Because the global parent, they withdrew their guidance, and the commentary on India is very, very good. I'm just looking at a couple of sales notes. The India power generation revenue could come in that vicinity of around 850 crores approximately, which will be a degrowth from what we saw in the previous quarter, which was around 1,250 crores. And on a year-on-year basis as well, it will compare with around 940 crores. And because of that miss, it will lead to the India business as well missing estimates. How would you approach the stock?
So, Nigel, that's a very important point. While everything's been very, very rosy in terms of numbers for till now at least, some of these, realities tell you that things are not so. I mean, a lot of the business are not out of the woods. And you triangulate this with the IEX data in terms of power consumption, the trading of power that's going on, and we are getting into peak power consumption months for the next 3 months at least. With all of this, what it tells you is that there's going to be a shift in terms of leadership and the supply chain. Now, some of these players which enjoyed, very superior demand trajectory will probably have to compromise or live with something where there's a shift that happens to lower cost or smaller units and, more fragmented distribution and things like that. So my sense is you'll probably see a lot of the transformer companies do better, and a lot of the BESS, play will start kind of contributing to power, which it hasn't in the last year. So I think a lot of people are gearing up for that, and that's where you should focus on. There are very few companies of scale, but whichever are there, you could probably gain much more than just the pure power generating, equipment. So I do agree there will be a pause, but Cummins has always done this. It's delivered even after these setbacks. So let the setback get digested, and if it's weak for some time, you'll probably start doing a little bit of bottom fishing here. But I think it will give you some time. 2,500 is where it will start kind of getting more attractive.
Okay. All right, Prakash, thanks very much. Great having that perspective. You have a good day, and we'll connect again soon. Well, the pre-open has kick-started, so just a quick glance. It's flat. It's very much in sync with what the implied open was telling us. 15 points higher on the Nifty. That's the sense for now. Let's put the spotlight on the oil and gas space. Of course, there's the fall in crude oil prices, which we have to take stock of. And then yesterday, IGL took a price hike. That stock was surging almost 6-7% higher. So let's discuss all of this with Anand Mittal oil and gas analyst at JM Financial Institutional Securities. And great to have you on. Let me actually start with IGL as a story, as a stock. Yesterday, of course, lots of excitement. They've taken this 1 rupee hike, I think. They took one in April. Now they've taken one in May. What's your sense on the stock? Because otherwise, there's a lot of regulatory overhang. Every now and then, this gas allocation ends up becoming a bit of a problem. And then more importantly, they are an NCR, entity, largely NCR based. And the policy in NCR, seems to be shifting a little more towards EVs. In fact, in between, there was this whole talk of completely phasing out, the three-wheeler fleet and making it all EV over the next 1 to 2 years. Your thoughts and call on IGL.
Yeah, thanks, Silvi. Thanks for having me. So yes, I agree. IGL, we have a structural sell on IGL and MGL, given both are CNG-dominated companies with 70% volume comes from CNG. And as you rightly mentioned, there are two key structural challenges here. One is the APM allocation, the cheap APM gas allocation is on a gradual decline, though partly they were protected because this was largely replaced by new well gas, which is not very expensive, 20% higher than APM. So they were largely okay. But on a medium to long term, given new well gas is part of that APM portfolio only, and overall APM portfolio is on a gradual 6-7% annual decline. So most of this APM allocation has to be replaced by LNG imports, which is at least 50 to 70% higher than the APM prices. So structurally, the pricing power in CNG will gradually deteriorate. And second key structural challenge for both these companies are that the EV policy, which particularly in Delhi, government is implementing on a kind of fast track pace, given the pollution concerns there, that impacts the terminal growth in both this business. So there's no visibility whether after 10 years IGL CNG volume will grow at 0%, 3%, or maybe -5%. So that's the reason we continue to maintain our sell rating on both the names. However, valuations are reaching at a comfortable zone. They're trading at 13-14 times P. So from that perspective, there was a bounce on these names given the price hike that it took. Yeah. So except for those trading bounces, which will keep happening depending on valuations. Yeah. Otherwise, I think from medium to long term, it's a structural sell on both the names.
You're at gas availability, and then the other is just this whole push towards EV. Before we talk about overall the fall in oil prices, then just to talk about also GAIL, if that's under your coverage, because yesterday there was a report suggesting that the regulator, PNGRB, is holding some sort of an open house. And once again, they'll talk about pipeline tariffs. What do you make of that if you caught that news? And what's your call on GAIL?
Yeah, so for GAIL, this pipeline tariff revision is long overdue. For them, this APM gas price assumption or the gas cost assumption that PNGRB had assumed during this 2023 tariff order was only $3.5 odd. But post that, APM got deallocated for the gas transmission business. So they had to use LNG largely, which comes at $10 plus. So that reset in the tariff order needs to be done. PNGRB had done that reset for GSPL a few months back. So it's a matter of time before it's done for GAIL. And there's a public consultation document which PNGRB has floated, which suggests a sharp 30-35% hike in GAIL's tariff, largely basis the correction on the gas cost assumption. So largely it's a matter of time before that hike comes. So we have a positive view on GAIL, primarily because of that long pending tariff hike, and also the transmission volume, given India is gradually moving towards gas, improving in its energy mix from 6% to 15%, maybe not by 2030, maybe more longer term. So that should give a good 5-6% transmission volume CAGR in the medium to long term. And valuation also is reasonable for GAIL. So we like GAIL as one of our top pick in the gas space.
So GAIL is your topic, and you're factoring in at least a 30 to 35% upward revision in tariffs, in the pipeline tariffs, right? You're baking that in your estimates.
Yeah, just that because we don't know the timing, we are doing it gradually over 2 years.
Sure.
Right. Dayanand, hi, morning. Oil marketing companies, what are valuations at, and what's your top bet?
Yeah, so the entire oil PSUs, OMCs, ONGC, Oil India, as you know, is a more top-down sector. So a lot will depend on two factors: where is crude prices stabilizing at, and second, what will government do in terms of either excise duty hike or fuel price cut. So first on crude price, so this OPEC surprise hike for second month took us also by surprise. I think there's a conflict between Saudi's short-term interest and long-term interest, and so does for US president as well. So though both parties would like crude to be at a relatively higher level, around 70. For Saudi, it helps them, given their fiscal break-even is around 80, 85. And also they need to keep selling stake in Aramco to fund their Saudi 2030 vision. Also for US president, this helps him to use energy as a key source of export to bridge the trade deficit. So long term, both the key players in the oil market would like oil to be at a relatively higher level. But in the near term, Saudi is trying to protect its market share and ensure the two defaulting countries in OPEC plus, Kazakhstan and Iraq, fall in line in terms of complying with the output cuts. So it's a kind of a threat in our view to these two parties to fall in line. And for US president also, I guess this is more as a negotiating tool to get Russia and Ukraine agree on the negotiation. So low oil price means Russia has less bargaining power. So yeah, short term maybe oil remains soft, which might be positive for OMC's marketing business, hopefully till government changes in its view on excise duty and fuel price cuts. But in the medium to long term, we are structurally negative on OMCs, more because of the huge capex which they keep doing on refining and petchem, which tends to be value destructive in nature. And also valuations for both HP, BP are at 1.5 times price to book versus historical 1.1. For IOC, is largely in line at about 1.1 time price to book.
All right. I have more questions, but out of time, Dayan. And thank you very much for joining us this morning, and we'll have you back. We'll continue and pick up on some of the points that you've made on that one. Well, a 9-10 call. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
Jubilant Foods. Consider buying Jubilant Foods with a stop under 706.
Okay. And Mitesh?
I'll go with a buy on RT Industries. Look at targets around 470 there.
Okay, Jubilant Food and Aarti Industries are calls coming in from Sudarshan and Mitesh respectively. Just the pre-open has come to an end. If you can just quickly put the Nifty Bank and Coforge up. So Nifty is up 40 points. The Nifty Bank will come up on your screen. It's flat. Nifty Bank underperformed yesterday as well. And let's just look at what Coforge is settled at after the big beat yesterday. It's about 5% higher. At the end of, the pre-open session has ended. And just maybe look at Cummins as well, because that's what we want to put the spotlight on next. Cummins, of course, the parent is suspended guidance. Stocks around about 4%. Vamakshi is here with details on Cummins. Vamakshi, morning.
Well, good morning, Prashant. Well, absolutely. The parent has gone ahead and withdrawn its guidance for 2025. Now, keep in mind that earlier they had guided for revenue to grow between the range of -2% to 3%. The global parent power gen revenues were also expected to grow between 5 to 15%. And the India region, which includes all of the entities of Cummins Inc. in India, was expected to see a growth of almost 10%. And they've gone ahead and suspended this guidance. The second important point that came through from the con call is that the India performance was very weak this time around. In fact, revenue for the India region as a whole saw a downtick of almost 14%. And thirdly, but the most important point that actually impacts the listed entity in India, which is Cummins India, is the power gen performance this time around. In the quarter gone by, they say that the power gen revenues in India saw a degrowth of almost 11%. They say that this is mainly on account of the pre-buy demand on account of the emission regulation change that took place in the same quarter last year. Now, keep in mind that for Cummins India, power gen as a whole is a very significant contributor to their revenues. So therefore, a decline and some soft commentary coming in from the parent company does impact, it does have a negative read-through for Cummins India. So therefore, the stock resultantly is down nearly 4% in pre-open.
Okay, all right, that's Cummins, which is in the limelight. By the way, look at Mahindra and Mahindra. I guess with the notes coming in and the analysis after another stellar quarter, there seems to be some follow-through action on the stock. 3150, it's inching closer and closer to its 52-week high. And another stock worth focusing on, of course, is going to be JSW Steel, because what we're also picking up from sources, and I think we'll have Sapna joining in just a bit on this. It seems the government may take a view on what it wants to do, whether it wants to become a party at all in the whole legal process that's underway right now. We'll get you more on that in just a bit. But Vivek, let's go back and recap the monthly update for IEX.
Well, that's right. So the monthly update for IEX, if you're talking about the combined, taking into account all of the segments that the company operated, it's still a healthy 20% year-on-year growth as far as volumes are concerned. In the key market, that's the day-ahead traded electricity volumes, it's a very strong print, 26% on a year-on-year growth, coming in at over 10,584 units. Now, when you're talking about the market clearing price in the day-ahead market, it stayed quite steady despite the much higher volume. This is at close to 5.2 rupees per unit. This is on a upon the fact that the company says that there has been much higher and much better liquidity as far as the sell side is concerned. The company says they are expecting volumes to inch up further on account of the upcoming peak demand summer season. As far as the renewable energy certificates was concerned, it's seen a significant dip, but remember, this has been a very volatile segment as far as IEX is concerned. 2.9 lakh REC certificates were traded in the month of April. It's still a good print as far as IEX is concerned.
All right. Thanks very much. 2% higher, Vivek, on IEX. Indian Hotels is the next one. Mangalam has got details. Mangalam.
It continues to do well this time around as well. 27% revenue growth is what we've seen. The EBITDA has actually jumped by about 30%. And all of that has reflected in the net profit, which has jumped by about 28%. Of course, the overall consolidated numbers were also aided by the Taj Sats business acquisition. But internals are fairly strong. The occupancy at 80.1%. This was slightly higher than 79.4% on an increased room base. And the average room rate also at 21,000, 14% higher than the same time last quarter itself. And this makes it the 12th straight record quarter for Indian hotels. The outlook for FY26, not particularly bad. 30 plus hotels to be added, focus on total revenue per available room growth and capture the growing MICE segment, which is basically the events, meetings, as well as conferences. And you have continued momentum coming in from new businesses, Ginger, Ama, Cumin, as well as Taj Chambers. And they are expecting for Taj Sats as well, new business coming in from the new airport kitchen at Jewar. So all these factors looking good for Indian hotels. Brokerage is also positive on the stock.
All right, Mangalam, thanks very much for that. Just a couple of seconds to go for market open, and we'll have rates coming up on the index, and then we'll go across and look at stocks. The Nifty is up about 20 points, so it's a more settled kind of open, 24,486 or so. The Nifty Bank is up about 0.1, that's 50 points, 70 now. Mid and small cap indices, 0.18, 100-point bump on the mid cap index. The big outperformer yesterday, of course, was the mid cap index. Small caps, lesser so yesterday, about 0.25% higher on small caps as well to begin the day. For the Nifty and the Nifty Bank, it's quickly kind of sort of blinking. It's turned into the red, but barely so. So it's a little directionless this morning as we begin the trading session. The heat map, and then, of course, straight into individual and specific names that are opening up. It's mixed, as the Nifty itself has indicated. Mahindra on one side, and I think on the other side, you've got a couple of these pharma names, Sun, Cipla, Dr. Reddy's. Surabhi.
Okay, so M&M holding on to that 2% gain for the time being. Nifty is suddenly blinking a little bit of red. On the upside, Bharti Airtel, M&M, ONGC, SBI Life, Hindalco. So it's very, very scattered, really no clear trends. Eternal and Trent, two names from the consumption basket, still tracking some green. Nestle has, just about an 8-9 rupee move on it on the upside. But pharma is all down, and this is what Ekta was telling us, that there is nervousness about what lies ahead. Right now, the Trump order that came in yesterday only talks about boosting local production, pharma production. It doesn't talk about limiting imports, but let's see. Cipla's, Reddy, Sun, everything is down. Reliance is the other one, which is down this morning. Geofinance, Reliance, these are other big names on the downside. But everything put together, it's very, very quiet on the Nifty. Now, again, about a 20-point up move. So it's flip-flopping, but the bulls are fighting back hard.
Well, that's right. Well, let's pull up a few stocks, actually, some good earnings reactions that we have. DCM Shriram, the margins expanded by 300 basis points. So that stock, in fact, has opened up gap up. The EBITDA number has gone up by more than 50%. DCM Shriram is the one that I'm talking about. Let's pull that up on the screen. CCL Products, the other one that's bursting away. Margins clocking 19.5%. The absolute EBITDA number was up by 35%. CCL Products, the other stock that's bursting away. Hind Rectifier, volumes not very, very high, but those numbers look good. Order book as well is high. And working capital days have come down over the last few years. So that's the other one that's up close to around 10%. Patel Engineering, I saw a flash, when we started on Bazaar, that they've got an LOA worth around 1,300 crores from the Maharashtra government. So I guess that stock is higher. But remember, it's been a relative underperformer, and it's corrected sharply from the top. Swiggy, yesterday it was swigging it away. The stock was up close to around 15%. The street likes some commentary that the management had said. It went up on very, very high volumes. The lock-in ends in the next few trading sessions, so we'll have far more stocks that will be eligible for trading. For the time being, it's cooled off a little bit. And Mahindra, what a beautiful stock that one is. It saw a sharp pullback in the month of February when there were the fears that Tesla is going to come in there. I'll tell you what, the stock is just 3.5% away from making a fresh 52-week high. So that's the kind of bounce back that you've seen on that name. And JSW Steel, there is hope that there is going to be some kind of rationality, some kind of some kind of news flow in favor of them, because as of now, the street was factoring that maybe that Bhushan Power and Steel asset gets taken away from them, and you don't know how much of the money will they recover. For the time being, there appears there is some movement on that front. We'll get Sapna to explain to us. That's why the stock is more or less flattish. But Coforge, the stock of the morning.
Just to add, and we'll get Sapna in some time on this to explain, what seems to be happening is that the government, and there's no clear view yet, but it seems, and she spoke with the Financial Services Secretary, and it seems that there is a thinking, because this could cloud perhaps the IBC process, other resolutions that are underway as well. So the government is considering whether it wants to take a view and perhaps become a party in the matter in some way or not. So those thoughts are out there in New Delhi, and Sapna will tell us more. By the way, Yes Bank is up 7%. The Japanese coming, the big name doing the rounds is, of course, Sumitomo Mitsui. Stock's up 7%.
All right, well, so we got 10-point lower on the Nifty, 24,450 is where we are at. Let's just look at the Coforge stock for a quick bit, and I'll give you a quick sense of the reaction coming through. 4%, I mean, numbers are outstanding, but remember, the market, the stocks, of course, come up quite nicely from lows of about absolute lows of about 6,000 rupees to about 7,600 as of yesterday. And, expectations were strong from Coforge. And of course, they've delivered maybe even better than what the expectation out there was. No question about what they've done relative to the rest of the industry. Apart from that, I think we are still kind of sort of, opening up. Market breadth overall, I spot more down than up now on an overall basis. Indian Hotels is the number one volume-led loser right now. It's down 3%, 780 on Indian Hotels. So it's got very large volumes on it, 2.5 million shares off the block. Cummins India is down 7%. I think we highlighted mentioned this earlier, but 7 lower now. Second largest volume-led loser. Nigel spoke about Swiggy, which is down about 2%. Paytm is coming up with large volumes as well. It's down 2.5%. Oro Pharma, if you want to talk about pharma names, Oro is down 4%. The rest are down 1%, 2%, 3%, but Oro is the big one, which is down 4.5%. Sun, Cipla, etc. I can spot as well. We spoke with RR Kabil, and the stock ended about 14%, 15% higher yesterday. It's down 2.5%, so it's just a little bit of a pullback that you're seeing. I can spot other pharma names, Divi's and Glenmark and Lupin. So these have all, by the way, got decent-sized volumes, which are there. And something like a Kalyan Jewelers is down about 2% as well to begin the day. It's completely swung now, fully 2:1 on the downside in terms of declines to advances ratio, although we'll have to see where we kind of go from here. On the upside, apart from what we've already mentioned, NetWeb was a big winner yesterday. NetWeb is up about 2% once again, on top of what we saw yesterday. OneSource Specialty, which is the CDMO company which Ektam highlighted in the morning, it's up 2%. So about 1695 or so. Tejas Network has had a very volatile last 2 weeks, 4% this morning on Tejas Networks. DCM Shriram, I think we did mention this.
Yes, DCM Shriram.
Yeah.
10% on DCM Shriram, 1110 on DCM Shriram. So big volumes as well coming through. And then I think we can look at a few other names
couple of more names. Tatva Chintan, the stock is up close to 10%. Big move is what we're seeing on that one. And Unicommerce E-Solutions, that's the other one. It's moving high on very, very large volumes. That is well up close to 7%. So select stocks with regard to news flow, with regard to good numbers, the street actually is gobbling them up. CCL Products, I think DCM Shriram, you mentioned, Hind Rectifiers, and a couple of other names.
We're just pointing out that the market started with a bit of a flare, including mid-caps, and now suddenly the color is a little different. It's not too much. Mid-cap index hasn't lost too much, but from the peak, it's down about 0.5%. So there's some element of caution creeping in, and advanced decline ratio, as of now, is negative.
Yeah, absolutely. Well, let's just welcome in Vikash Kumar Jain. He's India strategist and head of India research at CLSA. Is with us. Vikash, good to have you with us here. Thanks for joining in. What's the view now, Vikash? Markets have come up quite nicely from the lows. Trade headlines, etc. at the margin have also started to get a little better, but are we already kind of sort of pricing that in? What's your sense?
Hi, thanks for having me, Prashant. So I think Firstly, this is a very interesting time in terms of lack of predictability, and it kind of is humbling when we try and predict markets, that the kind of uncertainties that we are dealing with. And whenever we think about it, my thought process has always been that we need to think of things as probabilities and think of how narratives will eventually play out. There are 2-3 possibilities as I see over the next 2-3 months as things could become a little bit clearer. Firstly, we've had, in terms of announcements, the headlines was the worst at the start of April. Things have looked a little less, little bit more de-escalatory from that point onwards. However, de-escalation itself may not be good enough. Finally, we need to find solutions in terms of what's happening around global trade. And that solution is what the market will seek. Market is currently assigning a higher probability of a solution getting reached. Solution should be read as quick trade deals with most of the trade partners, implying a relatively muted impact on global trade on a slightly medium-term perspective. However, the test of that will be over the next 5-6 weeks. See, so far, bar nobody other than the stock market participants or financial market participants in the first half of April has really felt the brunt of what could play out if there is a global trade war. That will start being felt, starting with people who are involved in global trade, like the port operators in the US and the ship operators. Then it would flow down into logistics operators, and then finally the consumers, because there's been a lot of stocking ahead of this. And then when that stock kind of goes away, all of this, in my opinion, is going to become more visible in June, in second half of June and early July. Incidentally, the 90-day deadline to kind of get on a trade deal also starts becoming much closer towards the end of June, because that's, I think, 9th of July or so. So I would say we're getting to a point where things can again start flaring up if solutions do not become visible. And, that's what we need to appreciate, that we are in a little bit of a calm period where markets can go up on the basis of expectations, but those expectations really need to play out.
Vikash, hi, morning. You know what? I don't envy the job that you folks have right now. There's so many moving parts and so much uncertainty in the world that to predict, where the market is heading is not easy. But we're going to ask you exactly that, right? So, like you described, there are two camps right now. The Nifty for the year is actually positive. It's up 3% in 2025, so great turnaround. One of the camps is saying that irrespective of what's happening with global trade, money will come into India because we'll be better than the rest. So the flows will keep the market elevated. There's a second camp which says earnings are a little muted, and let's not forget we have a big geopolitical situation here at home. I mean, even right now, the market, for instance, is volatility. It's turned very swiftly just this morning, and this is a reality of how we are where we are. Which of these two camps would you be in, and therefore, what is the call for the year?
Like I said, that I'll say all of this with all humility in terms of being accurate or not, but just to kind of assess each of these camps. And in the way I look at markets, I try and pay a lot of heed on where expectations are. And after this phenomenal rally that we've seen, and what a turnaround it has been. January, February, the first 2 months, India was the third worst performer amongst all the large markets in the world. And March, April, it ended up being the best performing market in the world. But all of that is, that 3% scoreboard that you said actually hides a lot of excitement in terms of volatility that we have gone through. But I think what we need to look at in terms of expectations is simply where we are right now. India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. What we need to appreciate, and this is something which we bring out even in our note from today, in the first quarter, the only segment of the market which was seeing active increase, a clear increase in active weight for both FIIs and domestic mutual funds was the mega cap stocks. What I define as mega cap is the top 10 large caps. Everything else, that means other large caps, mid caps and small caps, is where they reduce their weight. Now, that just tells you one thing about this rally that we have seen. This rally in India has been driven by the need to find a place to hide. It is not a rally which is being driven by some kind of a beta where you are playing for the excitement of things continuing to get better from very good. That's not what is the foundation of this rally. And that is something that one should bear in mind. So the ones who are celebrating that India should be better off in a global trade war are correct, but that celebration should be muted, because if there is genuinely a proven global trade war, as one could fear, then in that setup, India will do well. But that definition of doing well does not mean that India will go up significantly. It simply means that India will fall lesser than others and India will outperform. But the other side of it is suddenly, if you see the US market, they've, from that big collapse, I mean, we almost had a 15% rally. That's like what a rally it has been in the last 25 days or so. That is suddenly also raising hopes that there is going to be trade deals. Now, if trade deals really play out, which is the other side of the coin of, this being only a temporary trade war caused by humans so that someone could get a better deal, if that is the angle, then suddenly the next leg up in the market will come from people who are part of global trade or countries who benefit from global trade coming back on the table. So I think that's a nuance that one needs to kind of think through. It's very difficult to imagine a situation where India goes up more than, globally things doing right. So that's a difficult situation.
There's a lot of caution. We're reading between the lines and you're very cautious. So what, best case, flat from here for the rest of the year? I mean, 5% up. Can you put some sort of a numerical range to this?
Oh, I think, let's talk about the good case. The silver lining for us is, yields have gone down significantly. And if I were to compare equity and bond valuations, they are not as inflated as typical equity in itself. So, I mean, equity to bond valuation is at a point where you can say they have been around the median levels for us in the last 13, 14, 15 years. So that's one silver lining for us. So I think for the market to even give a little bit of more positive return, the one thing that needs to hold is bonds. Our bond yields should not really rise from here. And that is something that is not an easy ask. Although, for someone who's looking at things in a very simplistic way, you can say that, yes, RBI is going to cut rate more. So ideally, that should be easy to hold. But if you were to compare our bond yields versus all of the global bond markets, it looks pretty expensive.
All right, Vikas, before we let you go, I think that FMCG basket was your anti-consensus call after being underweight. I think you turned relatively positive. And staples, I think, was your top bet out there. Does that hold? Do you see that being the relative outperformer for this year?
Yeah, so I mean, as you would have guessed, that I am not really in this to play a lot of big upsides. And in that setup, staples continues to be our big overweight in the India focused portfolio that we had. We made a few changes a couple of weeks back, but we've kept staples as the big overweight. So because we are just trying to find that defensive, which can give us a little bit of return, because we believe that should be that should allow us to outperform the markets.
All right. Vikash, I mean, no, absolutely. And I think some of those points are very well taken. By the way, Vikash, on IT services, we're speaking with the management of Coforge up next, which of course has been the outlier in the IT. Persistent and Coforge, of course, have been doing relatively much better than the rest of the IT services space. What's the big view there? I mean, do you have a view? I know, it's well established. There's a fair bit of uncertainty, etc. But what we are seeing is not just in terms of the trade uncertainty, but technological changes, etc. Is it a bit of a big issue?
So, they are, I would say, let me just kind of IT services, the big view is, since we are in a headline-driven market, for us in India, these are the stocks which will be the headline-driven stocks. Because if something goes wrong with global growth and with US growth, then this is where people will actually be finding their ways to exit or to kind of go short of the ones who can. So that top-down setup isn't great. However, over the last 5-7 years, these companies have come up with very clear cash return policies in terms of either dividends or buybacks. etc. And on that basis, some of them are now coming to levels which one could start seeing people who are more bottom up in their thought process could start seeing some kind of comfort coming in, because after a long time, these are coming back to long-term average, near long-term average valuations. Some of them, some of the large caps one. So without going stock specific, it's a little bit of a fight between the bottom up and the top down. I would say the point where the top down news flow starts waning, or the power of that starts waning, is when one should focus on the bottom up more. That is my personal opinion.
Okay, all right, Vikash, great chat as always. Thank you very much. Take all your points on board. We look forward to the next one again soon. Have a good day. Well, with that, let's actually touch base with the management of Coforge. The stock has been reacting to another good quarter. Strong revenue growth has come in, beating estimates. The deal intake is at an all-time high, and the deal pipeline has been looking very strong. TCV numbers looking very good. Sudhir Singh, CEO at Coforge, is with us now for some perspective. Sudhir, great to have you on. And we, of course, remember our last interaction because you always told us that FY25 was an exceptional year and you're poised for good growth. And that's what it is. I mean, 32% constant currency growth in the last year. Now, what about this year? Tell us, and if you could break this down, how much is it organic growth, this 32%? Because you're saying that FY26 you'll build on FY25. So give us some sense of the growth that we can expect, blended as well as the organic.
Well, we don't have a clear guidance for this year, and we don't offer a guidance. But FY25, as you very rightly said, has been an exceptional year. FY26, we believe, is likely to be another exceptional year. We are extremely strongly poised. At this point in time, our 12-month signed order book is 47.7% higher than at the same time a year back. And you might have noticed that through the year, which was FY25, the total order book came in at $3.5 billion US. So at the current point in time, FY25, rightly observed as an exceptional year, sets us up for what we believe is going to be an exceptional FY26 as well.
So should we expect you to reach that $2 billion revenue guidance earlier than what you had earlier said? Earlier it was FY27. Why haven't you just pulled up the timeline because of what you're seeing?
Well, we don't offer revenue guidance, but as we said yesterday in the investor call, we'd be very disappointed if all that we did in FY27 was just hit $2 billion. We believe we have a shot at doing slightly more than that. $2 billion was the guidance earlier. We are not revising the guidance, but we would be disappointed if, given how FY25 has shaped up, how FY26 is poised to perform, if we don't do slightly better or materially better than that $2 billion guidance for FY27.
I think they've not brought the guidance forward because I think it would have been too much for the market to take.
I think it's rephrasing, saying now FY27 will be materially better than 2 billion. So, interesting way of rephrasing it.
It'll be good. Sudhir, hi, good morning and congratulations. The numbers have come in stronger than what you guided for, and you've been sort of consistently sounding very bullish. So I just want to, I have a quality, the numbers we have, right? And you said on the call as well. Tell us a little bit about what you are doing that others are not being able to do, Sudhir. The secret sauce, if I can put it like that. Is it the segments that you're in which are perhaps doing better as compared to some of the other segments which other companies are catering to? Or is it your sales engine? Just three kind of sharp points, what you think you're doing well.
I think a very fair question. Let me just offer you three sharp points, as you said, in return. Number one, our sales approach tends to differ somewhat in that we focus on large deals-driven growth. What that means is we're looking for wallet share increase. We're not just looking for or waiting for client budgets to go up or go down and to then keep moderating or taking up our guidance. We go for large deals, 14 large deals in FY25, 5 in the last quarter itself is a testament to that. So that's reason number one. Reason number two, and I've said this, and I've had the pleasure of speaking with you repeatedly, is an execution intensity that is uniquely our own. We follow a three-step process, not just in sales, across the organization, which is plan, execute, debrief. Plan, execute, debrief, plan, execute, debrief, with debrief being the most important. We've done that for 8 years. When you build that execution DNA into a team, not just the sales team, the solutioning team, the delivery team, the alliances team, the partnership teams, then it becomes a moat. Then it becomes a growth driver, which is second to none. And finally, reason number three is a very deep, a very industry-led engineering focus. The $1.56 billion deal that we announced with Sabre, again, was engineering-driven, AI-powered engineering-driven. That's reason number 3 why we're growing.
Sudhir, on Sabre, and obviously that's powering you big time in terms of the deal flow, right? I think it's 1.6 billion was the total value of the deal. But there seems to be some concern on the financial health of Sabre. They seem to be deeply indebted, I think $5 billion of debt, etc. So could the receivables, not this year, but in the future, could they be at risk at any given point in time?
Well, the Sabre deal was very hotly contested. If I were to reflect back in the last 4, two of the players that we went up against were the large caps. So it's been a very sweet and obviously a very material deal from our point of view. Sabre has, and you would have noticed that just about a week back, divested their hospitality business for $1.1 billion, significantly bringing down their debt outlook. We remain very cognizant of the partnership that we have with Sabre, which has been robust. It's of more than 20 years standing. We're very aware of their financial standing at the current point in time. And as we've said, when the deal was also signed, we've got very strong commercial structures in place to make sure that just about any contingency that comes up is something that we address directly, squarely, and very, very early.
All right. Hi, Sudhir. Good to see you, Ben. We did track what Sabre did, with deleveraging their balance sheet, and that would be good for you. Your organic revenue growth for the past year was around 14% approximately. Now you have this big deal of Sabre as well. So would it be fair to assume that the organic growth could be in high teens from around 14%? It's going to be better, so it should be in that vicinity of, say, 15 to around 20%. Should it be around 18 to 19%? I'm looking at a couple of sell-side notes, and they are estimating that. Add to that the inorganic growth, we should be in the vicinity of, as a consolidated entity, to grow by around 23-24%?
Well, we don't, as I said, we don't offer numbers. I've seen some of the reports that you alluded to. All I can tell you is the confidence, and I suspect you can sense that from my tone and from the investor call yesterday, is sky high. It is not riding off deals that we will sign in the future. So that pipeline is very strong. It's also off the back of the signed order book that we have. So without getting into numbers, we believe organic growth will be very strong. And we will, as always, keep looking for inorganic opportunities if we find something at the right valuation through the coming year.
Okay, all right. So let's focus on a couple of aspects. You've said that your margins will improve as well. As you head towards that $2 billion target, what's your take? Where do margins settle at? I think for this year, you're guiding for around 150 basis points improvement. So once you hit that target, where are you headed in terms of targeted margins? And also tell us a little bit about the wage hikes. Will that be happening in the first quarter? Is it postponed a little bit?
Well, margins, we've been very clear. By the time we hit $2 billion, our reported EBITDA, I'm talking reported, not adjusted EBITDA numbers, reported EBITDA will go up by another 140 bips. We believe we are firmly on track to get to that. As far as wage hikes are concerned, we did our wage hike 3 quarters back. At the end of 4 quarters, which is going to be 1st of July, is when we will step back, look at the market, and take a call on wage hikes going in at that point in time.
Sudhir, just a sort of quick word on this entire AI business as well. Do you believe the common kind of narrative is it will not impact? But you just see the headlines from around the world, right? Salesforce saying that they're not going to hire any coders and programmers for the rest of the year. Microsoft saying 30%, I think it was 40% of the code already being written is being done through AI. For Indian IT services companies, is it a bit of a, not an existential threat, but what's your sense? How will this play out?
Prashant, if I reflect back on our growth and if I reflect back on why we are growing, one of the biggest reasons that I would attribute to is the way in which our sales engine has pivoted towards, and solutioning engine has pivoted towards AI-led deals. It's been the extent to which not just the delivery team, but the training function at Coforge has been able to, at scale, train folks starting off with foundational AI-based training, and the extent to which our sales pipeline is getting impacted by firms like Salesforce, by firms like ServiceNow, by firms like Microsoft, which are key partnerships for us. So from our vantage, at least from my personal perspective, I can say that AI is an incredibly, and we all know this, powerful general purpose technology. We realize that technology spends are only going up. We also realize that technology spends will pivot. As long as a firm, as long as a team is able to pivot with speed and align with the opportunities that AI is throwing up, good things will happen. Out of the 5 large deals that we closed in the current quarter, 3 would not have happened had the solution not been led with something, with a framework that was completely AI underbid.
All right. That's...
Sudhir, just one more point, Sudhir. You briefly spoke about some inorganic growth. Is there something that we should be hearing about in the near future?
No, there's nothing that's imminent. As I said, we keep looking at opportunities. If something does come up through the year, we will absolutely bite on it, provided the valuation is right, provided it is a strategic fit. So nothing that's imminent. But as always, we continue to look at opportunities. And our acquisition track record, as you know, has been 100% in terms of making them successful.
All right, Sudhir, we wish you all the best of luck. And of course, that Signity acquisition is sitting with SEBI, I think, and that perhaps will go through as well. Thank you very much. Thank you for joining us, and good luck to you and your team as you continue to execute. Because I think, from what I heard, it's all about execution and the way Coforge is going about it in the current environment. It's a nice numbers, 7777 on Coforge. It's up about 3.75% right now. Well, there's a review petition coming, and that's the big story which our colleague from Delhi, Sapna, is telling us. This is CNBC-TV an exclusive source-based information. A Supreme Court has, of course, scrapped the Bhushan Steel acquisition by JSW, and there is a review petition, we understand. Sapna, tell us more.
Well, it's all very early stages, so this is what we are given to understand. Probably a go-ahead has already been given. So sometime soon we may see some action on this front in terms of both the banks filing a review petition as far as the JSW BPSL deal being termed as illegal by SC is concerned. Having said that, if you observe yesterday, the DFS secretary was also extremely clear that within the government, they have actually studied the order with all the lenders, and a view is being taken in the government. Most likely they will finalize this very shortly. Obviously, all the legal opinion will have to be taken on board. So, just to give a background, Prashant, I think this week all the preparations are likely to unfold, and maybe next week, you could see action coming in. So one piece we have already put out in terms of PNB and SBI likely to file the review petition, and we have to keep a close watch on this story. It's a developing story.
All right, no, absolutely, and it's an important one at that. Reviews are rare, but one is being planned, as Sapna is telling us. This is early, but I think we should see, as she said, action in the next week. Sapna, thank you very much for that quick update. We'll come back with the management of CAMS as we decode their fourth quarter earnings. Stay tuned.
Welcome back. Well, let's focus on a couple of names. Before we do that, just pull up the intraday chart of Cummins. The stock actually has seen a bit of a recovery from the low point of the day. It got smacked back. I think it was down closer to 6.5% or thereabouts. Currently, it's pulled back a little bit from the low point of the day. So keep an eye out on that one. But as promised, let's get chatting with the management of CAMS. Their quarter four performance was a little bit lower than what some were estimating on the street. What's the outlook from here on, and how do you see business shaping up? Well, we're joined by Mr. Anuj Kumar, the Managing Director and the CEO at CAMS. Hi, Mr. Kumar. Good morning, and thanks a lot for joining in. Well, for the past year, you ended up with a revenue growth of close to around 25%. What are you targeting in 26%? And if you give us a broad breakup of this growth between your different businesses.
Sure. Good morning, and thanks for having me on the show. Just to kind of decode what happened in the fourth quarter, I think it kind of demonstrated the resilience of our model. Like indices, especially the large cap indices, fell almost 14 to 15% at the bottom in this 3-month period. If you see the results, our revenue went down only by about 4%, out of which you can think of about a 1.5% contraction coming because of business reasons. which is absolute volumes and business-related revenues, and about 2.5 to 3% adjustment because of a price adjustment that we were doing over a period of time for one of our large contracts. So it shows the resilience of the model, both the MFRTA business, the KRA business, and part of the payments business, not the whole of it, get impacted every time investor sentiment is down in the mutual funds and capital markets. So I think that's fantastic resilience. Last year was a great year. Like I said, we grew revenue by about 25%, profits by about 30%. In this year, I'm just cognizant of the fact that some of this price reduction that we had to do, about half of it has played out. The balance half has to play out over the rest of the year. So we don't give any forward-looking numbers. I think an overall revenue growth rate in the order of early teens is perhaps what you will see in FY26.
Okay. All right. Early teens. Got it. A couple of more aspects, sir, with regard to the profitability. You had mentioned in the past that we could be looking for some yield compression. Given that yield compression that we saw partly in the past quarter as well, will you be able to maintain margins in that mid-40s that you have been doing? And what are the levers you have to offset the impact of this yield compression?
So I'll give you the good news first. The good news is that in the non-MF businesses, we've grown in excess of 20% in the last 2 years. We're projecting about a 25% growth this year, which means wherever we have a platform functioning, I've already invested in the platform and sales and product, and any revenue that comes largely will flow to the bottom line. So non-MF has been a great story. Despite whatever happened, all the puts and takes, including the price in the fourth quarter, we are holding operating EBITDA at just short of 45%. Now, that's again a great testament to the resilience of the model. So again, my estimate is that in FY26, you will largely see one of the two numbers, either 43 or 44% operating EBITDA for the year. For the initial quarters, it may be more like slightly under 43, but we are almost confident for the year we should be able to return about 44%.
No, got that. In terms of the pricing from here, right? As you said, you took a price adjustment, Mr. Kathuria, with one of the customers. What would you have pricing leeway this year, or you think pricing perhaps moves the other way, a little bit under pressure as market environment, etc., remains a little uncertain, or it doesn't work like that? Just explain that to us, sir.
So the way it works is that in the digital era, the era of differentiated services is ending, which means that you will see almost a near uniform, I would not say uniform, but near uniform price across large clients. So I think that's the adjustment we made. In the non-digital era, till about 3 or 4 years back, we had some differentiated pricing that is going away. So you will see a small yield compression from here in FY26, largely led to this contract. Like I said, 50% of the adjustment we've taken in the fourth quarter, the balance will happen in the balance part of the year. But at an absolute level, we are confident that between 43 to 44% operating EBITDA should be delivered over the year in FY26.
So the non-MF business will grow at about 25%. On the MF business itself, Mr. Kumar, just give us some perspective. There's been a fair bit of debate on this whole SIP stoppage, etc., and whether eventually there's a fair amount of redemption pressure building up as well. What particularly are you anticipating on the MF business if the market continues to be range-bound?
I will just give you one headline. Read the collection numbers from SIPs, which grew in 4Q over 3Q and have successively grown over the quarters. Some attrition in SIPs has been a part of the marketplace for a very long time. A 40 to 50% first-year attrition is seen. But if you just watch what the collections have been, they've been extremely positive, and that's been a great sign. We believe the middle and bottom of the pyramid is holding this entire structure up. The Choti SIP and Jan Nivesh and those kind of things, as they get launched, will bring one brand new segment into the market. HNIs have not been holding up the MF market. So we are very positive that as the glue in the behavior of investors continues to demonstrate what it has demonstrated, they haven't panicked in the last 8 months and hopefully will not panic, you will see absolute growth from where we are.
What should we expect? If we talk about the revenue split, say by FY27, what will be the contribution of MF versus non-MF? And if you could give us some sense on margins on both these businesses as we look at the next 12 months.
The MF margins are in excess of 45%. The non-MF margins are in the range of 25 to 30%, which is a very good number. Remember that most of our businesses are of the order of a platform. So whether I take Account Aggregator, MF Central, Bima Central, all of those are typically platform businesses. So today, think of the margin split as in excess of 45 for MF, in the range of 25 for non-MF. Given the fact that most of them are platform businesses, most incremental revenue goes to the bottom line. So over a period of time by FY27, we believe that non-MF revenue contribution should be of the order of 17 to 18%. It's about 14% right now. It will continue expanding. And from a margins perspective, we see us recovering back to 45 and 46% in the next 2 years.
All right, Mr. Kumar, thank you very much for joining us and running us through all of that. Very, very useful information there coming through. Appreciate it. Well, let's move on to the next management. Indian Overseas Bank is the bank on our radar next. Fourth quarter numbers came through. Advances saw healthy growth. Margins have improved, while loan growth momentum is also healthy. We'll talk about the numbers on Indian Overseas Bank, but we'll also talk about the entire JSW Bhushan Steel issue. Mr. Ajay Kumar Srivastava is Managing Director and CEO at the bank. He's with us now. Mr. Srivastava, good morning, sir. Prashant here.
Good morning.
Our colleague from Delhi, Sapna, just told us that lenders are considering, and it should move forward next week. Hopefully, I mean, this is source-based information, that they are considering a review petition in this regard. Indian Overseas Bank recovered, the numbers that I have, about 760 crores from this resolution, which was about 2.6% of your net worth, which is about 2.6% of your net worth. Could you first tell us if you are privy to these discussions, sir, in terms of a review petition?
Yeah, in fact, these discussions are going on since the time the order came out. And the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days, the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get. And in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled it very efficiently without creating any adverse impact on the balance sheet.
I got that. So let's just take it one by one. First of all, you are confirming that discussions have been ongoing since the judgment, right? And a review petition is also very much at the table, but nothing has been decided. And perhaps action in the next few days is likely, right? I got that clear.
Yes, it is under discussion only at this stage. Nothing has been finalized. And as I said, that all options are on the table.
Review petitions are, the admission of review petitions are generally very rare in the Supreme Court. I mean, that's essentially just the history of it, sir.
I can say that nothing has been decided as yet. Everything is on the table only at discussion stage. Maybe in a couple of days you will come to know.
No, absolutely. I completely agree, and it'll be a joint decision in that sense, whatever is decided. But what I was coming to is, as things stand right now, how will you treat this? I mean, if, say, for example, the judgment has come and that's it, what happens? Will you have to, this money goes back to JSW? How will you treat it, sir? This recovery?
See, we are prepared for all the eventualities, and as I said, as far as IOB is concerned, the 760 crores in the worst case scenario, if finally it happens, and that if is a very big if. If it happens, we are having sufficient resources available in the balance sheet to handle it without creating any adverse impact on any of the numbers of IOB.
Will you have to create additional provisions, sir? That's what you're saying, right? And you'll be able to. The balance sheet is strong enough to be able to handle that. That's essentially what you're saying.
Exactly, yes.
Okay. All right. Hi, Mr. Srivastava. Good morning, and thanks for that detail. Couple of questions now. I track the asset closely, actually, and the asset today is in far better shape than what it was, say, 5 or 6 years ago. Are you optimistic? In fact, you can realize a bigger value from this particular asset whenever it goes for rebidding. And also, according to you, do you believe JSW Steel will be eligible to rebid for this asset?
It will be difficult to comment on that because lots of legal issues are involved. And the legal team is working on it. And I do believe that whatever decision happens, of course, it will be in accordance with the law. And whatever, I do believe that whatever is good for the Indian economy overall as a whole and for the banks, that type of decision will come out. That is what I believe in.
And maybe you can get a bigger value than what you got earlier because the asset is in far better shape?
Exactly. That can also happen, yes.
So that means that while there is a review petition, in the event there is a liquidation, I mean, your interests are more than covered, even if you have to pay back the 760.
Yes, absolutely.
Okay. All right, sir. So let's see. I think we have a next very important couple of days as far as this matter is concerned. And thank you for sharing the on-ground perspective with us. Now, I just want to come to the business itself, Q4. And want to start by understanding the asset quality picture, sir, because your slippages have increased quite a bit and you have taken high write-offs as well. Let's actually get those numbers on the screen for our viewers. Slippages at 2,753 crores, far higher than Q3. And there we go, write-offs at 3,000 crores. So with the write-offs, obviously the GNPA ratio is looking fine. So what happened, sir? Where are these slippages coming? What were the write-offs? And what are you seeing on asset quality?
Yes, so asset quality is perfectly fine if you look at the numbers. And there is one information which is already in the public domain regarding MTNL. And IOB was having an exposure of 2,330 crores in MTNL. That slipped in Q4. And against that, we have made 100% provision. And that is how the slippage ratio, the numbers you are seeing slightly at a heightened level as compared to previous quarters or last year also. If you take that 2,330 crores out of the total slippages, then total slippage for the bank as a whole, for the year as a whole, it's only 1,200 crores, which was 1,500 crores last year. So it's only one-off incident, one account. And that too, the balance sheet was so resilient that we have made 100% provision against that. And that is how GNPA and NPA, none of the ratios have been impacted.
Got it. Just a second, sir. I mean, we had the visuals from Ather Energy's listing. Maybe we can get them back up. It's an important one for the market, considering the way Ola went, not the best of experience for a lot of investors. Now, this is the next, the second pure play EV company to list. It's a quiet listing, which is what was expected. It was always supposed to be quiet. The subscription levels were also not the biggest, steady, about 1.5 times the total size of the book. There's over 2,000 crores of money, fresh money that's coming into the company. There are some existing shareholders that are selling as well. Big day for Ather Energy over there. But back to IOB. So what you're saying is that explains the slippage point, that it was all MTNL. But otherwise, asset quality looking good. So let's talk about growth, because growth in the fourth quarter was very strong for you. FY26, what is your loan growth target?
Yeah, last year also the guidance was 12 to 13% of growth in credit. This year also the same guidance continues, and anything about 13%, between 13 to 14%, 15%, that is what we are looking at. And in addition to credit also, I have to say that since entire industry is struggling for deposit growth, the guidance which we gave last year was to the tune of around 10%. And we almost were there, 9.86% growth in deposit we could show.
So 13 to 15% loan growth target is on the higher side. When you talk to most banks, most talk about 10 to 12%. So 15% sounds fantastic. What will drive it? Which segment? I mean, are you seeing a revival in corporate loan demand? Will it be MSMEs? Which segment?
It's all segment. If you look at the portfolio of IOB, we are having retail, credit, retail, MSME, agri and corporate, all equal proportion to the tune of 25 to 26%. And there's no concentration on any one area. So retail, agri and MSME will continue to grow, like we have grown around 20% over last year. And corporate, of course, will be we are going to pay special attention to that corporate sector, mainly on those industries where government's PLI scheme is operational. So those sectors we are eyeing at.
Okay, and just a quick outlook on the margin, sir, as well. Again, they've held very steady year on year. But as we look at the rate cut cycle, I mean, how quickly will you be repricing your deposits? And what should we expect on NIMs, say, over the next couple of quarters?
Yeah, there will be some pressure on the margin. Our NIM stands at 3.58 as on 31st March 25. And we do hope that there will be some moderation, but we are very hopeful that we can maintain it between 3.4 to 3.5.
Okay, all right. So we'll leave it on that note. Thank you very much. Very helpful conversation. Lots of perspective on not just the JSW asset, but the slippages, the NIM and the overall growth prospects. So looking confident as far as growth this year is concerned. That's Indian Overseas Bank. Back to the market, quick check. And things have turned for the worse, actually. The Nifty is down about 0.25%. Bank Nifty is down 0.5%. And mid-caps are falling a little more. Nervousness on the street. Mitesh is back with us. Mitesh, what's the advice now? Index and stock calls?
Good morning again. I think the Nifty, is struggling clearly around this 24,500, 520 mark. So wait for that to be cleared or wait for a decline to buy into. But on the stock side, I have one buy and one sell. IRB Infra is something which is slightly turning negative. So sell here with a stop at about 46 for targets of around 42.5. And Hero Motors, and in fact, the auto pack is doing well today. So Hero Motors, that's a buy. Keep a stop below levels of 3,800. Look for targets of around 4,000.
Interesting names there coming through. Well, 60 points lower on the Nifty. Mitesh, thank you very much for that. And we'll come back with more a little later. We take a quick commercial break here. We're going to come back with some specific stocks which are in focus and what's moving around. Market breadth is firmly down, 700 up and about 1,700 lower. Stay tuned. Coming up. Okay, welcome back. I think the markets, of course, under some pressure, about 50 points lower, not very much, 24,400 odd is where we are now trading at. Maybe just look at sectorally what's going on, because, of course, we're going to talk about stocks as well. The PSU Bank Index with a 1.5% cut is the top loser. The real estate index is down about 1.25%, and the Nifty Pharma Index is down about 1% as well. Actually, these are the three large indices which have got cuts over 1% right now. Otherwise, I mean, lots of 0.5% cuts, but nothing very major. The auto index, the Nifty auto index, perhaps is the sole large sector which is in the green. And I think it should say a big thank you to what's happening with, as far as Mahindra and Mahindra is concerned. I don't think there's anything else happening as far as the other auto stocks. Okay, actually, Hero is not doing badly either. So, actually, the top two gainers on the Nifty are Mahindra and Hero. 3% on Mahindra and Hero, which is up about 2.75%. So, that's that. iSure is up about 2%. I'm looking for some other auto. Bajaj is up about 1.25%. Yeah, so it's actually a bit of a sectoral move. Led by, of course, what's happening with Mahindra. Let's actually talk about that particular name, right? Mahindra and Mahindra. And Sud is here with what the street made of the numbers and the commentary posted. Sud, over to you.
It seems to be a good day for all the auto stocks, but especially talking about Mahindra and Mahindra, it's a consensus buy by brokerages. Most of the brokerages remain positive after Q4 results that company has posted. Amongst all the auto names that have posted results so far, M&M's results were the strongest one, and even brokerages are positive for the FY26 outlook for both the segments, auto as well as tractor, and target prices as high as rupees 4,000 per share. So first, talking about Kotak Institutional Equity stake, it maintains buy call target here is 3,500. It says company is firing on all cylinders and strong FY26 outlook that company has given for across verticals, and it expects company to continue outperforming industry even in FY26. Jefferies too maintains buy call and it has a target of rupees 4,000 per share. It says company has delivered 12th consecutive quarter of double-digit EBITDA growth, and there is a room for further re-rating with strong growth outlook and improving franchise. For Jefferies, Mahindra and Mahindra remains its top pick in the auto, also in the list of preferred buy list, and it sees 18% core EPS CAGR over FY 25-28. CLSA maintains outperform call and it has raised target to 3652, but it has lowered FY 27 earnings estimate by 1.5% on higher depreciation expenses, and that is related to electric vehicles. Nomura too maintains buy call and it has raised target to 3779 from 3681. It says company has reported industry-leading results, and Nomura maintains company as its top pick, and it expects SUV CAGR at 14% over FY 25-27, and it believes that BEV, that is born electric vehicle, will be a key driver of sales growth. So overall, it's a consensus buy. Most of the brokerages remain positive on M&M after Q4 results, as well as regarding the outlook for FY 26 that company has given.
All right, so thank you very much for that. Cummins is the other one on the way down, though. Vamakshi is here with what they've done with regards to dropping the guidance. Vamakshi.
Well, absolutely, Prashant. You know, the first point that came through from their Q1 2025 numbers is that they've withdrawn the full year forecast, and they have done this on account of the tariff-related uncertainties. Now, earlier on, they had guided for revenue growth in the range of -2% to +3%. The power gen revenues were expected to see an uptick of 5 to 15%, and the India region as a whole was expected to see an uptick of 10%. But given the kind of tariff-related uncertainties that are unfolding, they've gone ahead and withdrawn this guidance. The second important point is the performance of the India region. So India region as a whole for the company saw a degrowth of almost 14%. Now keep in mind, this is not just for Cummins India, which is the listed entity, but there are several entities of the global parent in India. So this degrowth of 14% is for all of these entities combined. And the third point, which is the most important point for Cummins India, is the performance of the power gen business. Now for Cummins Inc., the power gen revenues in India saw a degrowth of almost 10%. They say that this is mainly on account of the pre-buy demand that we saw on account of emission norm changes in the same quarter last year. So therefore, given the kind of degrowth that we're seeing in the power gen business for the global parent, it has a negative read-through for Cummins India, and that is because a significant portion of their revenue comes in from the power gen business specifically. There could be some downward revisions to the earnings estimates for the quarter four for Cummins India. Overall, negative impact, negative sentiment. Overall, going with the stock is down and out in trade today.
Okay, all right, Vamakshi, thank you very much for that. It's a pretty comprehensive explanation of what's happening with regards to Cummins, about 5.5% lower. Now, news reports suggest that Sumitomo Mitsui Banking Corp has gotten the RBI approval to buy 51% stake in Yes Bank. But I think we want to provide a clarification on this story, which Lata is going to help us with. Lata, over to you. What are you picking up?
Okay, well, the flash will come up in a minute, and what it will tell you is that the story is incorrect. Banking sources, usually very reliable, have told us that this story is incorrect. Reserve Bank has not given any nod to any entity to acquire 51% stake in Yes Bank, and that is because there is no application pending in front of RBI from Sumitomo Bank. So this story is baseless, comes from sources who are usually reliable. And we also contacted some legal people who normally work for the Reserve Bank, who do central banking issues. And they say the law allows an entity, if found fit and proper, to hold up to 26% stake in a bank. Like, for instance, in Kotak Bank, Mr. Uday Kotak holds 26%. That is the maximum that can be allowed under RBI rules. 51% would be very, very unusual. It has happened in the past. In Catholic Syrian Bank, you had Fairfax. But it's an extremely unusual situation. This is what the legal source told us. But the important point for us is that this story is entirely incorrect because there is no such application in front of RBI. That's what we are picking up now.
Well, that's quite great. Not only is there's no approval, there's no application.
That's the point.
Stocks coming off. It started to come off a little bit. Was up 4.5%. Has given up a little bit of those gains as we speak. So that's that. Well, we'll take a quick commercial break here. I'm going to toss it across to Lata once again. On the segment is the economy. And she has Pranjul Bhandari today from HSBC on India's growth prospects later this year. Stay tuned. Coming up.